Thank you, everyone, for coming. We have an all-star panel of venture capitalists, the best in the business, handpicked. They're all my friends. So I'm proud to say they're all my friends. I've worked with them for many, many years. So when Google said, let's do a panel, a VC panel, I said, I'm there, and we can bring the right people here. Before we get started, I have a couple of questions for you and one announcement. Tonight, there will be a reception hosted by Google Ventures. Joe Kraus is one of the partners right here. And David Crane over here from Google Ventures. You need a ticket like this to get in. So if you want to come to the Google Ventures reception, see David Crane or Joe Kraus or myself, and we'll get you a ticket to get in. Let me start with a couple of questions. How many of you are from startups? Raise your hand. All right, that warms my heart.
Google does not count as a startup.
Oh, that's true. That's true. And how many of you might be either seeking funding or will soon be ready for your next round? Raise your hand. Okay, so keep your hands up. Okay, VCs, those are the guys you want to talk to. There's about $1 billion of capital sitting here. $1 billion. So you only want 50 million, right? So should be okay. Should be easy to do. There are mics over here in the audience, so we want you to come up and ask questions throughout. So I'll be watching and recognizing you for questions. Okay? I'm going to start with a few, and then we'll take your questions. But first, let's start with introductions. In case you don't know these guys, let's have a minute or two introduction for each of you. Let's start with Brad. Sure.
Brad Feld. I'm managing director of a venture firm in Boulder, Colorado called Foundry Group. We do software internet investing all around the U.S. We're 4 partners, $225 million fund, 20-something companies that we've invested in.
My name is Dave McClure. I paint houses on the weekend for really low rates, so if any of you guys need any work done, let me know. I do earlier stage investing than Brad, I think. Probably if you're looking for $20 checks, I'm your guy. Done about 40 or 50 investments over the last couple of years with Founders Fund running their early stage program and the Facebook incubator program last summer.
Jeff Clavier, he moved next to my house, and so he's spending it. I manage SoftTech VC, which is a $15 million fund that has done 49 investments in the past 2 years. Before that, I did 24 as an angel, so I'm one of the most active guys in the Web 2.0 space. And I'm thrilled to be on the panel that doesn't talk about VC investment, but something else. Thank you, Don.
Matt Holleran, Emergence Capital. Emergence is a little different in that our whole firm is focused on business applications and particularly recurring revenue business applications. In the freemium market, investments include Yammer and EchoSign and YouSendIt. And in the SaaS world, companies like Salesforce.com and SuccessFactors.
My name is Joe Kraus. I'm a 2-time entrepreneur. Started Excite in the early 90s and a company called JotSpot about 3.5 years ago, which I sold to Google. And recently joined the dark side of Google Ventures. And I think we have 11 investments thus far, and we're a relatively young shop, about a little over a year old.
Okay, so this is a panel about freemium and free trial and revenue models for startups. So to start, maybe we should level set and just have a brief explanation of freemium, free trial, and maybe other revenue models. Anyone want to take that and just explain what we mean by freemium?
So I'll give it a try. Typically, you're going to have an application with a set of functionality, which you're going to make available for free. And then a subset of those features will be only available to people who pay a bit of money because they have reached a point, whether it's time, whether it's capacity, whether it's storage, that has maxed out the free version. And so you will say, hey, if you want to continue using our product, or if you want the convenience of additional features, you can pay us a certain monthly fee. And typically there is a recurring model where every month or every quarter or whatever, someone pays something.
And what about free trial? How would you contrast freemium to a free trial?
I just think the simple thing is the free trial is typically the fully featured product, which you're allowed to use for a limited period of time, and the freemium model always has a free component or always has some functionality that's free, and then you can pay for additional features or capability, users, et cetera.
I guess I'd take a slightly different approach on it, which is in the business application world, freemium is a pretty revolutionary new business model. And part of how it's different is that business freemium applications are bought. And historically, business applications have been sold. And as Joe just described, a free trial is inherently controlled by a salesperson. A freemium application that you're using, you need permission to sell to that end customer.
So freemium is sometimes not recognized as a significant business model that you can build a significant company from. But here are a few examples of companies that I think did pretty well. Skype, I think everyone knows Skype. It's a multi-billion-dollar company built on a freemium model. LinkedIn, Flickr, Pandora, Ancestry. I think TypePad, Dropbox, there's tons of them. The common thread there seems to be, though, that these are consumer-based applications with millions and millions of users. And my question is, can enterprise apps also use freemium? Can it work? Do the economics work?
So I guess one thing I might point out as an example of that would be Twilio, which isn't quite free, but the enterprise version of freemium is really fucking cheap versus big SLA that cost me a lot of money. And
It was only 2 minutes before you swore. That's a land speed record.
that's my modus operandi now, is get it out early so people aren't waiting for it, and then we can move on. Twilio has a relatively cheap cost structure. However, I think if you sort of want more enterprise SLA agreements, then there's definitely more that you can pay for the product. And I think a lot of, not necessarily consumer-facing products, but products that are for developer audiences can be sold in the enterprise at the departmental level at a relatively inexpensive cost. Typically, once the kind of corporation or enterprise wants to start using it in a more regular fashion or with some level of support, then there might be an opportunity to sort of step up to a larger cost structure. So not quite freemium, but maybe, freemium-er.
Matt probably has the best data, I assume, given that he funds mostly enterprise SaaS models. But I personally think it's a little tough in the sense that my data may be a little bit old, but rule of thumb I always think about is it's about a 2% asymptote on conversion for most applications from free to premium. At least that's what I've seen and seen in my own experience. Some of the antivirus guys and some of the registry cleaners get much higher than that, upwards of like 11 to 15%. But most people aren't registry cleaners and most people aren't antivirus companies. So I think one of the tough parts to the freemium model is when I talk to lots and lots of freemium companies, the data all seems to suggest that there's about a 2%, not limit, but that most on average tend to yield 2% when they're up and running and humming.
So I think the game for someone who has a freemium model in mind is to have a massive funnel that they can drive people through and eventually convert a certain percentage. So that's why it sort of lends itself naturally to the consumer market, because you can have tens of millions of users, and if you convert only 2% or 5%, it's still a lot of users.
You have some interesting historic proxies for freemium in the enterprise, and the best one to use, and then I'll map it to Google specifically, but the best one to use is SharePoint, which essentially has an incredibly broad footprint in the enterprise, mostly because for the first handful of years, Microsoft gave it away as part of the ELA agreement. So you essentially got it if you bought the ELA agreement. You got this extra functionality for free, and then over time, if you wanted to have it broadly licensed, there were opportunities to then buy up the package. It's interesting if you sort of make the metaphor to things that cross over between consumer and enterprise. Gmail and Google Apps seems like a pretty natural example. I can use Gmail forever for free, and there is a clear opportunity for me to then pay for Google Apps to start to have certain things that I can't get if I just have Gmail. So I think it's a little subtle in its difference because we're so tuned into at least people that are building consumer-based products, you're so tuned in to give away a lot, convert 2% to extra functionality, whether it's specific features or storage, et cetera. But I think the opposite is true in the enterprise, which is give away something broadly and get distribution as you build more value on the product and get more people using the product, then layer on a paid service. And so really it's the same model, but a different approach.
Excellent. I'd remind you there are microphones in the audience. Just step up to the microphone if you'd like to ask a question.
I was just going to point out that I think there's like 2 or 3 different reasons why you would offer something for free. So one is because you're trying to give the user time to understand what the product is, and if you charge for it right away, they might not take that time. So that's kind of learning about product benefit. There's free because that user is going to provide distribution benefit in viral fashion to other users. So I might tolerate them being free forever as long as they're inviting other users into the product. And the third one is maybe close to that, but you get network benefit by having more people in. So you may tolerate them being a free rider as long as they're adding value in some way. It may not be by invitation, but by participation in data. So I think understanding why you're trying to like get users in and what version of that will drive whether it's free trial or freemium or free forever or free completely.
Yeah, and I think I guess our results are it's working in the business context, and the scale of the conversions is in the kind of 1 to 10% at limit that we're starting to see. To Joe's point, you want these markets to be really big, but 2 factors connected to the virality right now are really no business application other than Intuit historically has penetrated the 10 employee and less business. Gmail and Google Apps is changing that, and the VSB market is many, many tens of millions in the US and in North America. And these today, out of the chute, the freemium business application companies are serving the globe. And so what might not have been markets that worked in a SaaS context 5 years ago, and certainly didn't in a SAP Oracle context, are now at scale where that can work. And then to the point on the difference between consumer and business is, I might love this thing and it's a great service, but now there's 5 people or 10 people, like Chuck at SlideRocket just mentioned in the previous session. He gets now 5 or 10 people from Google Apps off the marketplace that see the solution versus 1. And you can start to seed applications and then sell them a more expensive product later that change the economics pretty significantly in the business. So I guess the model is really going after new segments and new opportunities today that are of scale that can really make the economics work, and it's pretty exciting.
Cool. Brad, did you have a comment?
Yeah, I think one thing to also be aware of, I'd just add a 4th thing to Dave's list, and do I get a call if I say fuck too early on? Good, okay, just checking. So there's a lot of people that get confused about direct versus indirect revenue models as well in the context of freemium. And I'll give a good example from my experience. I was an investor in FeedBurner, and FeedBurner had a free version, and then they had a $5 a month version that you got a bunch of extra stuff. You got analytics and a few other things. And when Google bought the company, we had 500,000 publishers using FeedBurner. And of those 500,000 customers, we had 2,000 of them that paid us $5 a month. So our $10,000 a month revenue stream was worthless in the freemium model. However, by having 500,000 publishers, we were aggregating hundreds of millions of unique ad impressions a day through all of the distribution that we had, and our indirect model became advertising through those impressions. And so I think one thing that a lot of companies get sideswiped in that we see early on is that they have this notion of freemium where it's just systematically built. I mean, I don't think the FeedBurner guys thought that they'd only have 2,000 people paying for all the extra happy stuff. The very first thing Google did was make those 2,000 users free and gave those functionality across everybody because they recognized that the value of the incremental unique ad unit was much higher. So sort of in a counter freemium model, don't get hung up in losing sight of the fact that you might have a better indirect revenue opportunity than direct, and always challenge your free to paid user versus what if it was all free? Do we have an indirect model? There's an interesting backlash that freemium came from for anybody that sort of remembers the Web 2.0 history was that there were these enormous number of companies that were going to make it up on volume, right? They were going to have huge enough traffic that they were going to have a big enough advertising revenue stream. And at some point, everybody realized that, when you have 10,000 unique users a day, you can't have enough advertising to make a business. You got to figure out a different way to do it. So one of the things to think about when you're starting down the path of a freemium model is, are you a company that's going to have tens of thousands or hundreds of thousands of users, or are you a company that's going to have 50 million users? And if you're going to have 50 million users and you can leverage the network effect type activity that Dave talked about, the freemium model may actually get in your way relative to the indirect opportunities that you have for advertising.
And in fact, I think that oftentimes the big issue in freemium is not whether to do freemium, but what's the product feature segmentation on the free versus the paid side, and how do you sort of like, which features I'm going to put on the paid side, which features I'm going to put on the free side. In general, things that are viral or growth oriented probably shouldn't be on the paid side, they should be on the free side. And maybe stuff that sort of engages users in more deep behavior is probably stuff that you might want to consider putting on the paid side.
I think there's a real danger in the freemium model, which is it creates a weird cultural split inside your company. And I saw this at JotSpot, where you're constantly having discussions about to Dave's point, what do we include in the free version, what do we include in the paid version? And your company can get a little of kind of a split personality, with some people pushing for holding things back, some people pushing for greater growth, and it's really hard to know what that line is. And the line evolves over time. I think the second really important thing is pricing and how you do pricing. So one of the lessons we learned at JotSpot, we studied cell phone pricing a lot. Because if you actually look at cell phone pricing, people, if you look at large kind of cohorts, pay one greater tier than they should. And why do they do that? Because actually the rational thing to do is pay one lower tier, and the 2 months a year you go over, you just pay the overage. And you'll actually net a lower bill at the end of the year. The reason people do it is they're not optimizing for lowest price, they're optimizing for least surprise. And so one of the things we did when we looked at our tiers of pricing at JotSpot was, how do we create a tier, like the initial 2 tiers, let's say at $19.95 a month and $29.95 a month, had limits on things like users and pages. If you went up to $49.99 a month, then you essentially got one of those categories became unlimited. And what we saw is our average revenue per user, which we tracked weekly as we adjusted pricing plans, was that people still, even in software, optimize towards least surprise. They don't know how they're going to use this stuff. As long as it's within the range of kind of cheap enough, then they'll optimize to least surprise and basically take the higher plan, even if they don't use it. So we saw people taking plans which were essentially had an unlimited pages component and were using by far fewer pages than they could have at the next price level down. But they did it because they were pricing for least surprise.
Interesting, very interesting. So this is a good segue into my next question.
Awesome, feedback. The point that I wanted to make, though, about the other thing you said was you think it develops a split personality. I actually think that's okay, because I think there's 2 things that you're trying to optimize for when you're running these businesses. Is one, you're trying to optimize for user happiness or utility. The other one is you're trying to optimize for business value. And sometimes you're playing a zero-sum game with that. Hopefully not always. And great businesses are where you're not playing zero-sum games with those 2 things. But I think it's actually okay to have a customer advocate in your company who's always trying to figure out what's going to make the customer the most happy. And somebody else is like, hey, we got to keep the lights on. Yeah. How do we make the most value in the business? And having that, that dichotomy of conversation on an ongoing basis is probably okay, in my opinion.
I'll revise the statement. What's actually important is that you start from the beginning with the model you imagine yourself to have. Meaning what too many companies, when they start up, basically put the product in beta before putting their business model in beta. So what they do is they typically release a free product, they don't have any pricing on the thing, and they start to get a bunch of users. And the users get excited, they have a fully featured product. And then the conversations start to go like this. You have 10,000 users, 20,000 users, and you start to get nervous. Well, gosh, if we introduce a paywall, how is that going to change our growth? And boy, we seem to be valued and get all the love and feedback inside the company, and these people from the outside who might fund us love us because we seem to be on this user ramp. So all I'm saying is at the very beginning, make a decision and put your business model into beta at the same time you put your initial product into beta, and that way you don't have the tough conversations of being really nervous that you're going to retard growth ramps that aren't really real.
I'd also add, knowing that, and I agree with Joe's sort of approximate, 2% conversion. Maybe it's a little more. So there's a couple of cases where it spikes up a lot higher, but it's a low percentage. I think that if you try to implement sort of over-architect it too early, you also don't understand what you're doing. Because let's say that you say, we're going to have a premium model, we're going to have some extra features, you get some user adoption, and you put out your freemium model. This is the free one. This is the $14.95 a month versus $15 a month, because somebody told you should be $14.95 a month. And you got the wrong segmentation. If you don't have tension early around what that segmentation is, you'll stick and anchor on that segmentation and you'll slow your user growth down. So what I tend to see works is you know that you're going to introduce a paywall at some point, but you wait until you have enough robustness in the product before you start to do that segmentation, and you play around with that segmentation. And I think the dissonance in the company in that case is super helpful, because then you'll have people who are in the company fighting for the user. This has to be a core feature, it can't be a paid feature, and then you'll have somebody else make the argument, yeah, but this is why people are going to pay for us. And you have to get that conversation going in. The companies, and you know, FeedBurner was an example, oh yeah, we'll just add stats on and people will pay us extra for stats, and the answer was no, they won't. And oh, by the way, if we'd had stats for free, we probably would have had more adoption, because there would have been some people that would have said, we'll get some extra benefit from this.
I think that FeedBurner was a good example of a product where it was so good on the free side that there was absolutely no reason for you to take the paid one. It's only when they introduced this notion of advertising where you would get paid for your impressions that I felt compelled to pay them something, because I felt guilty. So introduce guilt.
But that's interesting, because they didn't need you to feel guilty, because they took a percentage of the advertising revenue, right? So they didn't care. The interesting thing was they had competitors who charged for their functionality. They actually got the right mix, I think, of lots of functionality for free, because the people that charged a relatively small amount for the other functionality ended up with like 17 people using their product, and FeedBurner ended up with 500,000. So that's the other side of the equation, which is that if you're going after scale, you have to really concentrate on where you're segmenting to go after scale. I think that is part of the problem then with the enterprise type activities, because if you're selling into an enterprise customer, and let's not talk about the very small business, but sort of anything else, you're still dealing with an Oracle Salesforce, you're still dealing with a Microsoft Salesforce, you're still fighting against SaaS. So you've got to figure out a different approach into the customer still on top of a different engagement model.
So if the free product is so good that there's no reason to pay, then your only alternative then is to say, well, we'll limit capacity, right? So you can only do 100 a month or 1,000 a month or whatever the scale is. So that's really the tough problem. It's where do you draw the line? Do you draw the line to say we're going to hold back certain features and make those the premium that you pay for, or we're going to give them all the features but limit capacity and have them pay if they go over capacity? So how have you seen that work, and what are your recommendations?
It really depends on the product. I think that if there is a notion of quota of capacity, I think Dropbox is a great example. I'm not involved in Dropbox, but I think it's an awesome product. And so you get 2 gigabytes for free, and you can pay for like whatever, 10 or something like that. And I think that in between, there is a very large sort of band of users who will sort of try and force themselves to stay in the 2, because 2 gigabytes is pretty large for web storage. But what Drew said, the CEO, is that if they were to lower that bar, try and introduce an interim sort of step, they would actually lose money, because people, just as Joe said, just graduate into the 10 gigabyte offer just for safety. And so when you have those kinds of products, you can definitely sort of play on storage capacity limitations. I think that the whole limitation on product is dangerous, because there's always sort of something you want the users to experience to make sure that you maintain a competitive edge.
I think the other opportunity there is as you're starting on your journey, is you need to be clear on the runway in useful functionality for an individual per the discussion, and set that mark at something that they delight in and they're really happy about, but hopefully you have some more to drive some individual conversion. On the business app side, though, is you could really have a very useful individual product, and your goal very well could be, I'm going to upsell the group. And that can work beautifully. And so, but if you don't have enough runway individually, and you don't really have group value in the enterprise, it may not be something you want to embark on.
We have a question from the audience here. Let's take that.
I want to know individually which characteristics does a good business have for each one of you?
What characteristics would a business have for this?
Well, yes. Which characteristics for a good business have So it's a question for each one of you.
Oh, so does it have to be viral? Does it have to be consumer? Or what kind of characteristics do you look for? Is that the question?
I think it's...
I would like to hear more about the values of now we have to protect our investors. Now we have to be true about these characteristics of the product, or we have to be true about ourselves, or
I think I guess I would say, well, the awesome product, of course, is a real-time viral Groupon. I mean, that's obviously going to get everybody to get their checkbooks out. But I think one of the things that we've been sort of talking about is getting to the essence of what's the value to the user and virtual goods, right, virtual goods. Because I was going to say, Joe's comment about like not shipping your product without putting your business model in a beta is pretty on target, but even getting to the like kind of reverse psychology on this, I don't know how many of you have ever read Predictably Irrational, but I think that's a great book to read before you start trying to think about any type of freemium model, because some of your intuitions about how people are going to react to pricing are very, very different. And in particular, I think there's times when you can charge for something that people perceive more value than when you give it away, and so the behavior aspects of sort of having something free or not free are not going to at all look like what your expectations are there. So, and in fact, founder of a company in Japan, largest cooking site in Japan, Cookpad, founder Akisano built a business over about 12 or 13 years. They went public last year, doing very, very well. He actually thinks completely different about it, is that he doesn't want to launch anything that people wouldn't pay for right out of the gate, because it sort of sets a way that users think about your product to be value-oriented. And I'm not saying that works for everybody, but really establishing, you know, the value of your product is probably more important than understanding pricing models right away. And so getting to the essence of value of your product is probably the first priority, and then figuring out how do you layer on pricing that's either free or discounted on top of that.
Brad mentioned virtual goods,
Yeah,
and I know Brad is an investor in Zynga, which makes a ton of money on virtual goods. It was in that case.
Well, I mentioned virtual goods just to be part of the trend word dropping. Dave's point's profound. I want to emphasize it. Actually, I think
I agree with you.
Yeah.
Your point is profound.
it's fucking profound. It's really, really important. Your instinct about what the consumer, or what your customer, business or consumer, will pay for or not pay for is likely wrong. It's very easy to come out with a model after you've read some blogs and talked to some people and thought in the bathroom about something, and it's probably going to be wrong. And so you have to be agile and flexible enough early in the life curve of your business, if you're going to approach this model, to be able to listen to your customer feedback, your user feedback, and also have the right premise. If your premise around your business is that you have to have 100 million people using your thing, and your thing is not viral in any way, shape, or form, it will not work. If your premise is that you only need 10,000 people to pay you $1,000 a month and life is good, free may not be the path. Or the thing that you do for free may be different. So testing it aggressively and iterating is important, but hanging on to Dave's concept that your intuition is probably not right. The other thing I just want to weigh on, which Don said, is what if your product is so good that the free version is all anybody will ever need? And that assumes stasis, assumes that nothing changes. And everything's changing constantly and evolving constantly. And I think that's another opportunity where once you start to have enough users, finding the 1 or 2% of those users who are fanatical about your product and having them help you segment where the paywall should be is actually quite useful.
I think an interesting case in that is LinkedIn. So, I mean, LinkedIn is a clear case of products free. I don't know why I would ever pay for kind of what they currently are charging the users for on the freemium model, and they monetize generally on really a special segment of users, which is biz dev and recruiters and other ones. Now, I don't know whether that's right or not. I actually think there's potentially a chance that they should have charged for the business premium users, because I sure as hell would pay $20 to $50 a month for the value that I get out of LinkedIn. And, but they chose this model where, okay, we're going to give the user a bunch of benefit with really not too much limitations on functionality and monetize a completely different user segment that will pay because there's large network effects going on.
There's large value from the people that will pay disproportionately high for the other 98% or whatever the percent is that won't pay anything at all, right? So you might pay $50 a month for it, but somebody else will pay $500 or $1,000 a month for it, or $5,000, and so they need a whole lot less people paying to make the same aggregate revenue. So again, there's so many pieces in it that sort of looking for that right spot. And actually, I think having a competence early, this is, back to Joe's point about, you have sort of two parts to the company. Once you start sort of rolling down this path, figuring out how to let that dissonance be part of your decision-making process in a constructive way, I think, is really powerful.
Okay, we have another question from the audience.
Hello, my name is Yoav. I'm from Taipei. I have one comment and one question. So the first comment is that you mentioned many different models of revenue. And it feels to me as if freemium mostly is when dealing with the direct consumer. When we're talking about giving them away the product for free, while we can get some of the money in other ways, like advertisement that was mentioned here and information collection. So I wonder about the balance between those different models. And the second thing is that you mentioned Zynga a few minutes ago, and Zynga have a different model. Zynga give the product completely for free, and they ask the consumer to pay by enabling features, by paying for them every time. You actually buy coins, you buy virtual currency, you pay for specific features. After a while, you have to buy those again. So it seems like another model of freemium, and I would be happy to hear your comments about it.
So obviously Brad knows most about Zynga, but I've spent a bunch of time looking in the kind of mobile gaming space where the economics are slightly different, but the mechanisms are the same. And I'll just kind of parrot a bunch of stuff that comes out of Neil Young from NG Moco talked a lot about his metrics at the Game Developers Conference a while ago. So what's interesting about their metrics are that on a daily basis, they see about 2% of their audience actually buying something with virtual goods. Now, one of the most important parts in that model is that there are a legitimate play path and a legitimate pay path. And that balance is really important. I don't know what the analog in business software would be, personally, but that 2% kind of scales well to other data points that I was mentioning earlier, about 2%. The more interesting part to me is that about 25% of their audience will do something in exchange for the paid currency, typically in the mobile case, cost per install advertising. And so in that particular case, as you mentioned, the balancing act, and then a third component is essentially display advertising. But all of that adds up into the magnitude of 15 cents a daily active user per day. So it's amazing how collecting pennies over enough users where you're combining freemium, where you're actually getting revenue directly from a customer base, but where that again seems to be tapping out at about 2%, where you have other people willing to get value in the game in exchange for doing some other action which you can monetize. This is kind of akin to what Brad was talking about in terms of indirect monetization with advertising in the case of FeedBurner, and then obviously advertising. So anyway, that's just another example of kind of a revenue mix that might be interesting.
You've mentioned the 2% conversion rate a couple of times. I did a survey of 25 companies that are using freemium model, and it was very close, but my results were between 3% and 5%, depending on the price point that they were charging. Lower price point got 5% conversion, the lower price 3%. So if your business models have conversion rates of 10% or 20%, you're smoking something. It's not right. It's going to be between 2 and 5%.
Yeah, on this point, I think there's two kind of follow-ons I want to make. One is that entrepreneurs live in a reality distortion field. I've been there many times. I love my little bubble. But the reality is that most people don't know what you're talking about with your product. And so there was an earlier question about should you charge for holding back features. The reality is most people are not going to pay you for features. You think your features are incredibly valuable, yeah, but you spend 24/7 thinking about your product, understanding what the value of those features are. It is likely not going to happen. I very much personally prefer the notion of being aligned with your customer. The more they use the product, the more they're seeing value, the deeper they're getting in it, then they're willing to pay something. That's at least my own impression. You need to hold some carrots out there, some words that make people feel like they're getting a little more value than just additional stuff for what they're already using. But again, I strongly prefer things that are aligned with the way the customer's using the product. And avoid the trap of thinking that customers are going to pay for features they won't. Customers don't pay typically for analytics. They don't pay to turn ads off. They don't pay for, at least in the enterprise case they will, but in the consumer case they're not going to pay for better support for the most part. So that's one. Two is, always remember, at least in, again, this is my own personal opinion, it's much easier to raise prices than to lower prices. So I always like starting with lower price points and creeping them up very aggressively and measuring on a weekly basis what I'm seeing in terms of average revenue per account. The reason it's easier to raise prices than to lower prices, the people who got the earlier price feel like they got a smoking deal. When you lower prices, they're very pissed off. So it's counterintuitive. People are afraid to raise prices. Raise prices. It's not hard compared to lowering prices.
A couple of comments. One is on the 2 to 5%, it depends as to whether you look at your overall user base or your active users. Because typically you're going to try and focus on your active users in terms of conversion. And so you're going to see a much higher conversion rate by definition because the active users is a lower population. In terms of the consumer, people will actually pay for convenience. One of my companies did something that you shouldn't do, which is they actually took something which was available for free and they made it available only behind a paywall. And it was a pure revolution amongst the user base. But after a year, we end up with a 4% conversion rate. We're making millions of dollars on that 4%, and we just went past the renewal. So after a year, we were very anxious looking at the churn we'd have on this sort of year after a year of activity. And so far, we've seen 70% of people sort of renewing. So I'm not suggesting to piss off your users, but be aware that at some point, if you have a product that is really sticky and people want to use, and there's convenience, and they will actually pay.
I think this brings up a point about instrumentation, right, and really knowing usage. And so it drives on two things. One, the active user retention is something that generally SaaS companies aren't thinking about because they're only thinking about paid user retention. But thinking about active user retention, instrumenting the service, really knowing the clicks and streams and functionality that people are using and how to engage them is a really, really big point, not only for you getting them to convert, but for them to go tell their friends. And this brings up a big difference between what I'll call kind of early recurring revenue model businesses and kind of early SaaS and these, in that these are really service businesses at the end of the day. I mean, people, and in fact, in many of these companies, 40 to 60% of the employees are in technical support and customer service, and they think that's great because they're really worried about active users, telling their friends, and then driving conversion and doing the work to make sure that all of those things happen. Contrast that with kind of historical on the business app side where 50 to 60% of the folks were selling. In this case, it's 40–60% are servicing, and it really speaks to some of the cultural differences between these entities and those that came before.
One comment on analytics, and then one comment on sort of the context of freemium at the infrastructure layer in terms of infrastructure service, which we haven't really touched on, that I think is becoming increasingly visible. Raise your hand if you have a company, an active company today. Keep your hands up. Lower your hand if you don't get a detailed statistics report every day on daily active users and what they're doing in the application. Be honest. Okay, that's 25, 33%. 100% of you should be obsessed with that. And every company at the very earliest stages, even if you have 4 people using your software, you have somewhere between 5 and 10 daily metrics that you should get every day and you should think about, and then think about them on a weekly basis and a monthly basis. And Dave's got brilliant stuff on SlideShare about this and on his site. No, about the actual metrics you should look at. But understanding those metrics and understanding the difference between a daily active user, a weekly, and a monthly active user, understanding what they're doing in the application, and understanding how that changes over time, especially when you change the application, is so critical early on, and so many startups that I encounter have no idea what it is. I love the reports that say, have a handful of columns on a daily basis, 7, 7, 8, 8, 14, because that day it went from 8 to 14, you can say, what happened there? Like, what was it? And very early understanding those nuances will help you understand the dynamics here. But don't sort of defaulting into the 2%, Jeff's point of, is it daily users, is it sign-ups? Then shift into the infrastructure thing. You're seeing more and more companies like this. We just made an investment yesterday in a company in Boulder called Simple Geo. And we have another investment that should close by the end of the month that has exactly the same type of approach, where it's a free infrastructure service for a certain amount of usage, certain number of API calls, a certain volume of activity. You can use the service for free and integrate into your service. Once you get above some level, then you have some tiered pricing based on your consumption. So if SendGrid would be another one that we're all in, that we recently led around, and that Jeff and Dave are also in. It's one of those things where the infrastructure piece of it, this is a business service, you want lots of people to try it, and you're willing to have that marginal cost on your side because it's cloud-based, cloud deployed, your marginal cost is relatively low. When there's user value, the users will happily pay your paid service once you get above that hurdle. So it's, again, the same kind of thing. If you have 1,000 people sign up and 0 use it past that sign-up period, nobody's going to pay you $5,000 a month for it. If you're not tracking it, you have no idea, and you could be telling yourself, oh yeah, we got lots of people signing up every day, why aren't we getting anybody that converts into actual real users? So getting those pieces lined up is really important.
Great advice. Write that down. If you aren't collecting analytics on how your users are using your application, you're flying blind. And if you succeed, it's going to be total luck.
And
so
on that
make
point,
sure you do that.
On that point, the other thing I was going to say is looking at a sort of unsubscribe report, or at least a cohort analysis for retention over time. Like, I think a lot of times understanding what your balance is going to be on a freemium model, or how much you want to charge for your product, whether it's free or not, is based on average customer lifecycle. And like, a lot of people do look at daily reports or look at aggregated stats where users are of different age. And you may not be able to tell as much from that unless you're looking at the cohort that's just new user behavior within a certain time period. So like, an interesting report that's probably a pain in the ass to generate but useful to look at is kind of a look back from current time frame of users within the same week, right? Or users within the same month. So here was a cohort of users from 3 months back. What's their behavior been? Okay, here was the next 1 week, cohort. We changed something. Then what happened to the subscribe rates or the unsubscribe rates? And so getting an understanding of what's your average customer retention over a billing period, and starting to build some understanding of customer acquisition cost, and then figuring out if you're upside down or not on that is probably essential to understanding if you have a business.
We have 2 questions from the audience. Let's go there.
Yeah, hi there. My name is Mike. I'm from Winnipeg, Canada, and I have a privately funded small startup that we're doing a booking application, and we kind of have a big vision to sort of take it to a one-stop appointment booking shop for common services, which kind of isn't out there from what I've seen. And so one of the things we're trying to do now, and what I wanted to ask you is basically we're trying to figure out our pricing model and potentially some sort of a freemium model, and trying to figure out whether pay-as-you-go pricing, and in our scenario it could work because we're trying to sell initially a web application that lets businesses schedule appointments essentially. So it's not new, there's already companies doing this, but we just think we're going to do it better. Now, traditionally most of our competitors are pricing on a tiered pricing model. I'm really wondering whether a pay-as-you-go model is better in that, for a small shop that's only booking a few appointments, why are they going to pay $20 a month, right? Where they could pay, a few cents per appointment type of thing. And then how does that fit in with a freemium model, and how would you transition that?
Crowded market. I know I saw Yuri Nelkin here earlier from TimeBridge, Tungle. So there's a bunch of companies in there trying to do this. And they all have slightly different business models. But let's hear from Joe.
I'm only scared of pay-as-you-go models mainly because they're unpredictable and people get scared of what they don't know. So the fact is that they might think, it's interesting, I think people tend to go towards, what if I did 1,000 appointments this month strangely? I don't think I will, but what if that happens? So I tend not to like those as much, mainly because what you really are looking for is you don't want customers to have to think very hard. And they have to think when it's a pay-as-you-go model, because then they have to stop and think, well, how many appointments do I really book? Because most people don't actually know. It would be my instincts, but so that's why I tend not to favor those.
I think it's also, you have to be careful on the bond math in all of this, and you have to be clear, as Dave described earlier, in the customer life cycle. And so your cost to get a free user, your cost to get a paid user, and then how much they're going to pay you. If they pay you up front for a year, they basically have recouped the cost of marketing to them. And then what's the monthly retention look like on go forward? Because you'll be financing their pay as you go. And if that bond math all works, that's all free coming into you, they love your service, and 99% of them will stay, and you're winning because it's pay per use, that bond math might work, but you have to run the bond math all the way through. And in these businesses in particular, as we were talking about retention, these are very different business application retention rates than SaaS or other services. You know, they're 1 to 10 to 15% churn per month, right? You have 15% churn per month. At the end of the year, you don't have a lot left, right? So, but people think about those differently because people move in and they move out, and they'll do it for 3 months and they'll come back. And how do you think about, you know, that math? So I guess it all really comes down to what's the bond math really look like for your full customer lifecycle for paid. And if that works and enables you to differentiate, then that may work, except for the kind of the fear questions that Joe surfaced. But you want to run it all the way through.
Let's get another question.
Hi. You guys talk a lot about the subscription model where people pay month after month. What do you think of the model that seems to be in the mobile space quite a bit, where there's like app light, and then there's like full app, and the app light is free, and then the user jumps over the wall once and pays a large bulk of money to get the full featured app?
That has been very popular as a model on the App Store, because that was the only way for companies to have a premium model where there was not the in-app commerce didn't exist. And so the math typically would lead to a, surprise, surprise, 2 to 4% conversion, where the price point, so at Tapulous, which is one of the largest app on the App Store, we sort of did a demand curve to try and see what the optimal pricing was, and essentially, once again, surprise, surprise, you know, $4.99 seems to be sort of the optimal. Now that you have an opportunity to charge in-app, you really want to do your math, because essentially, if you're able to get consumers to buy things on a repeated basis, you know, $1.99 two-track song, or you know, whatever sells on some first-person shooter, you will have a recurring revenue of sorts that will make you way more than that $4.99. And so,
I think it sucks, and I think it's a function of a limitation of the App Store, sort of the first wave of it, and here's why. We're talking now about bits, not atoms, right? So bits cost us nothing. The storage cost of them is nothing. The distribution cost of them is nothing from a manufacturer perspective. So you never want a customer to be a single purchase or a single instance experience, because all of your effort is to get engagement with that customer. And if they have a single instance experience to purchase, to pay you something, whether it's $1.99, $4.99, $4,000 for your bits, and you don't have another way to keep doing it, all that effort to get the customer to write the check the first time, go back to Joe's point earlier, psychologically or philosophically, don't make people think hard. I love this thing you do. I want more of it. Oh, it costs me more money. Okay, here's more money. But if I can't ever give you more money, I won't. Right? So I think, you know, Jeff's point was exactly right, but I'll just put a point on it, it was a constraint, not a feature. And it's something that I think will always exist. I mean, you can still buy PC software and pay $29 one time for it. And once you've paid your $29, it's not like the new version comes out, you want that new version for free or for whatever your upgrade price is, but you're not going to pay anything more than $2.99 for your annual maintenance agreement because you're only willing to pay 10% of it, right? It's a tough place relative to the fact that the storage, shipping, distribution costs of this thing is zero. Sorry, I didn't mean to grab it.
you did. I would be...
I couldn't help myself.
I agree with Brad. I would just say that once you have enough distribution, you have actually the freedom to do a bunch of different things in terms of special versions and that's a recurring virtual good or whatever you sell. And essentially, the goal is to increase the ARPU or the LTV of the customer. And as long as you create things that they want to buy through different channels, then you're just off a good start. But I would just say that the one time, hey, I've sold my app for like $5 and that's it, is just not an attractive model at all.
Okay, we only have a few minutes left, so we're going to go to the lightning round now. Short questions and 30-second answers. Okay, next question.
You all talk about
Speak up, we can't hear you.
Yes, you talk about you having a business plan before you start, but you also talk about how you're always wrong or you're often wrong. How do you make sure you're not stuck in the bubble where better business plan, could be available, but you just don't see it because you're in a bubble?
Analytics.
Yeah, I was just basically going to say, the HP famous phrase is you make what you measure. And so my only piece of advice on that particular front is, and I've screwed this up twice, is get your analytics in place before you launch the product. Invariably, when every product discussion before launch that I've ever had inside a company is always, it's the last thing, it's not done, but we're at some event, so we're going to launch the product on that particular day. We can't get our dashboards done. We'll do it the week after we launch, and it happens 5 months later because you're incredibly busy. So
And in order to discover things, you basically...
The point was start logging the data before you can even analyze it. That's right.
And you try new things on a sub-portion of your user base. You do split testing, you try things like special campaigns or whatever. If you want to change the business model, obviously you don't want to change the entire thing, but if you have a hunch based on your usage data that there is another opportunity, then you try the opportunity on just a cohort or something.
Next question, we got to go.
Yes, just clarifying that the testing and iteration is great for local max optimization. It's not necessarily greater for non-local max discovery. So I still think you need to create a process. And when your conversion starts decelerating on your process for local max optimization, that's the time to then jump to non-intuitive leap for a new feature and potentially new business model.
Okay, next question.
For small and medium businesses, is the lack of advertising, in your opinion, enough of a feature to get money out of them? In other words, where does advertising in freemium play?
Hi, Bob. Good to see you.
Yeah, I think it was addressed earlier in the sense that you have to think you have scale. I think the only real freemium models that are working with advertising right now in business applications are Google Apps, which is working well in a mixed mode of subscription and advertising, and LinkedIn as described, and they have scale of 7 to 100 million users. Because advertisers don't really care for some of the volumes that that people start to see. But if you're starting to think about how can you get leverage in these things early, because it can take a while for your virality to happen, I will encourage you to think hard about the Google Marketplace and Google App integration, because companies like Batch Blue are growing their customer base by 100% more than they were doing before, and their retention rates will be a lot higher. Or ManyMoon, as you might have just heard. So you can do this on your own and run for a long time on your own, or you can stand on the shoulders of giants like Google and others and really leverage a freemium base globally to get your business cranking.
We didn't pay you to say
I
that.
also think a very small percentage of people will pay to not have ads. And if your ads are so offensive that they will pay to not have ads, they're not going to use your service. So you have sort of a very tough balance right there.
Next question.
If your application is targeting high net worth individuals, for example, or a client base that has a lot of money, is it wise to just try to, I know you mentioned earlier it's best to raise prices rather than try to lower them, but like at what point do you say, hey, this is actually a good price and a value for my clients, but clear up here is where they'll pay? I mean, how far do you push that bar?
As far as you can before they stop paying.
As far as you can.
So that math should be relative to competitively available alternatives. So if there's no competitively available alternative, charge through the fucking nose. And by the way, don't worry about making it perfect before you launch either. If there's lots of competitive alternatives, then you have to do the math of available pricing, whether the audience is aware of those other alternatives, et cetera.
Cool. Thanks, guys.
Next.
Yeah, the applications that we're developing wants to try out the Latin American market, and that tends to be a little complicated because it has some new challenges, posing some new challenges. People are not as used to electronic payments as you guys are up here, so the conversion rates may be a little lower. But also we have a problem with lack of bankarization. I don't know if that's an appropriate word, but not as many people have actual credit cards that they can use in the United States. For example, the Venezuelan users, they have currency control. They cannot use a credit card up here. So you have to look into alternate methods of payments, like, for example, SMS micropayments and whatnot. What has been your experience in using freemium models for them? Is it better to try and force some kind of monthly payment for them, or go and use a sort of virtual currency method where you buy credits and you use the credits as you go? I know we've touched on pay-as-you-go method, but we have new challenges here.
Well, you want to try and shoot for a frictionless payment. And so if there is a ton of friction in your geography, I think that the credit model can work, because you just load up once your credit and then consume them. The good news is that you can therefore disconnect the act of payment and the act of consumption. But we used to have people who can bank, so we're sort of less used to those models.
Billing and management of subscriptions is an enormous business opportunity and problem for you in this mode. And internationally in particular, in some cases people are substituting labor for the payment, and it's fine because they'll tell people who may have the ability to pay, so I wouldn't be as concerned about that. Google Payments, as they've just announced, will be part of both Marketplace and how and where you can get paid from your end customers. And other suggestions for you, PayPal now has operations in hundreds of countries around the world, and has an active mechanism for freemium companies to get paid, as well as some of the other gateways. But both the getting paid and then the management of the subscriptions is harder than you might think. And again, without being paralysis to prevent you from starting, you want to put some time and thinking into this early, and there are some vendors who are focused on it.
And not missing the opportunity to pimp a portfolio company. Recurly might be a great option for you to check out. Others are Chargeify. Probably not Zora unless you want long contract fees and expensive implementation.
Okay, last question.
Yeah, you discussed briefly about quota, about having a business, having your base package. It's free, it's great, everybody loves using it, but creating that quota of, well, you can store 5 megabytes worth of documents but you paid to get more space. In your experience, has that been a viable business model, paying for space? Because as you said, bits are free. How likely is a user in the end to pay to get more space to store stuff? Does it just depend on what the base product is?
So here's the other weird thing, is that free is anything that you wouldn't take the time to unsubscribe for. So actually, I think there's a lot of models where free really feels like less than $20 a month. I'd be cautious about sort of annoying people to the end of their means, but so Dropbox example, there are lots of other alternatives for paying for stuff. I don't know why, certain people want to pay $20 a month for Dropbox, other than the fact that $20 a month to a lot of people doesn't feel like a lot of money. So what you're really going after there is, here's something useful, and here's something I think is close to free enough that I don't care about it.
I think the key to having that dynamic work, though, is that the product has to be awesome. Right? It has to delight. It has to be something that doesn't cause you to go look for an alternative that costs less than $20 a month, because you instinctively know they're out there, but you're so delighted with this product that you're willing to keep paying for it. Right? So I think that's part of the challenge. And it's interesting, there's a lot of free things that could disintermediate, for example, your cable TV system, and they just aren't worth it yet because they don't delight enough. They're too hard, and I don't want my wife to call me like she did and say, I can't get this to work. And so I'm willing to pay something until that point. You can scale it across the whole thing. So just really focus on your product delighting in that context.
That's where
yeah, and I think keeping in mind that if you're in the enterprise, if you're below the $10 sort of mark, you can expense everything on your credit card. As personal individual users, $3 or $5 a month is just not that much money for a delightful experience. So yes, in the case of Dropbox, if I need it, I will pay for it, and even I won't wait until I'm sort of at the threshold. I would just pay because I'm really happy. I don't want to bother searching for something else. And so I think that it's really the user experience that you're driving for, and then you figure out what is the right hurdle that will sort of get. This sort of notion of demand curve you will try to find where it's optimal to get people to pay for X amount at X capacity.
Okay, thank you.
Okay, a reminder, if you're an entrepreneur or a startup and you'd like to attend the Google Ventures reception tonight, you need one of these cards. See David Crane over here, or Joe Kraus or myself, and we'll get you hooked up. Thank you all for coming here, and join me in thanking my panel.